Welcome to The Explainer. Okay, let's just dive right into the central mystery of why the global economy feels so incredibly tight right now. Seriously, if you've been wondering why mortgage rates just absolutely refuse to fall, why stock markets seem to randomly freak out every few months, or why things feel so restricted even when rate cuts are on the table, well, you're definitely not alone. The answer to this giant puzzle, it doesn't start in Washington, and it doesn't start on Wall Street. It actually starts in Tokyo. See, we're constantly bombarded with the loud stuff, right? The AI tech bubble, chaotic Washington politics, hyperanalyzing every single syllable Jerome Powell mutters at a press conference. But the quiet reality, the actual truth, is that the most boring asset on Earth, Japanese government bonds, has been acting as the invisible duct tape holding the entire global financial system together for the past 30 years. Traditional media kind of ignores this because, let's be honest, it takes a bit of patience to unpack. But that duct tape, yeah, it's starting to peel. To understand why this matters so much to your portfolio and your life today, we've got to rewind a bit. Let's go back to 1992. Japan's massive asset bubble bursts. Real estate collapses, equities tank, and the country enters this punishing period we now call the lost decades. We're talking 30 years of virtually zero real economic growth, no inflation, and absolutely zero wage expansion. It was like their entire economy just hit pause, and nobody could find the remote. The Bank of Japan was completely out of traditional options. So what do central banks do in a total panic? They cut interest rates to zero, and then they actually cut them below zero. But when even that wasn't enough to jumpstart things, they took this incredibly dramatic, unprecedented step. They rolled out a policy called yield curve control. Now, I know yield curve control sounds a bit like a Marvel villain, but it was really just a blunt tool to force their domestic long-term bond yields to stay at virtually nothing. The Japanese government essentially stepped in and said, we're capping long-term bond yields whether the free market likes it or not. They took a giant tube of superglue and stuck interest rates directly to the floor for decades.
And that brings us to one massive, glaring number, 0%. Literally nothing. Because domestic Japanese bonds paid exactly 0%, it created a massive existential headache for major Japanese institutions. Imagine for a second you're managing a massive Japanese life insurance company or a pension fund. You're sitting on a billion-dollar portfolio that you absolutely have to grow for your clients, but your safe, reliable domestic government bonds are paying you nothing. You basically have two choices: accept zero return on a mountain of cash or go shopping overseas. Obviously, they went with option two. Japanese institutions went on a multi-decade global shopping spree just chasing yield. They became the largest foreign holder of U.S. treasuries, massive buyers of mortgage-backed securities, and ultimately, the world's largest net creditor nation. Basically, Japan turned into the world's ATM.
Now, the math on this was actually incredibly simple, which is why it was so wildly lucrative for global macro hedge funds. Think about an investor using this strategy. Step 1, borrow a ton of money in yen at those near-zero interest rates. Step 2, convert that yen into U.S. dollars. Step 3, take those dollars and buy U.S. treasuries yielding, say, 4%. Step 4, after paying some tiny hedging costs, you just sit back and pocket the spread between the 0% you owe and the 4% you're earning. It's like free money. This exact sequence is what became famous as the yen carry trade. Capital just flooded into this, with institutions borrowing essentially free money to pump into higher-yielding foreign assets. And here is where things get absolutely wild. You don't just take practically free money and carefully buy safe U.S. treasuries. When your borrowing costs are near zero, you buy tech stocks, you buy real estate, you buy into emerging markets. Basically, if an asset had a pulse and yielded more than 0%, the yen carry trade bought it. At its absolute peak, banks estimated this trade was worth trillions of dollars. It became one of the biggest single sources of global liquidity out there. The entire global financial system was essentially running on Japanese Wi-Fi. Everything was connected to and completely powered by this endless stream of cheap yen. But let's fast forward to 2024, because this is where the whole thing hits a dramatic breaking point. The entire yen carry trade relied on one massive assumption, that Japanese yields would stay at zero forever. But earlier this year, the Bank of Japan finally pulled the plug on yield curve control. They raised interest rates for the first time in 17 years. And then they raised them again. The free money math flipped instantly, and the market reaction was violent. Following that second rate hike, the U.S. S&P 500 dropped 6% in a flash, and Japan's own index, the Nikkei 225, plummeted over 12% in a single day. That was its worst drop since 1987. It was a massive, blaring siren that global markets were officially spooked. So why the violent reaction? Well, it comes down to one word: repatriation. When Japanese yields rise, two things happen immediately. Borrowing in yen gets more expensive, and hedging your currency risk gets more expensive. Suddenly, that free money trade isn't a no-brainer anymore. The capital flows that rushed out of Japan for 3 straight decades suddenly threw it in reverse, and that money started returning home. This great unwinding, this repatriation of capital, is literally one of the biggest, most fundamental threats to global liquidity today. Investors are waking up to a really uncomfortable truth. The absolute cheapest source of global oxygen for the past 30 years? Yeah, it's not cheap anymore. To truly grasp the sheer scale of this threat, we have to listen to the heavyweights. Take Ray Dalio, the founder of the world's largest hedge fund. He says the bond market is the basis, it's the backbone of all markets that determines what all asset returns are going to be. He points out that when the supply and demand picture for bonds breaks down, long-term rates rise, currencies shift, and you get a scramble out of bonds that put central banks everywhere in a total bind. The absolute foundation of everything we value in the financial world rests right there on those bond yields.
And honestly, this points to a massive misconception we see every day. Everyone is obsessively watching the Federal Reserve. Financial media hypes up Jerome Powell's press conferences like they're dropping a trailer for the next Avengers movie. But here is the reality. The Fed only directly controls short-term overnight rates. It's actual supply and demand that drives the 10-year, 20-year, and 30-year long-term yields. And those are the rates that actually dictate our economy. Remember, the U.S. is running trillion-dollar deficits year after year. We have to issue massive amounts of new debt just to keep the lights on. And for decades, Japan was the reliable, price-insensitive buyer absorbing all that supply.
So if Japan steps back, we enter what I call the everything story domino effect. If our biggest historical buyer stops buying, yields have to go up to attract new buyers. This creates a steepening yield curve where long-term rates stay painfully high, even if the Fed is cutting short-term rates. And that triggers a brutal domino effect. First, stock valuations compress. Analysts use long-term yields to value future cash flows, so if yields are high, stocks trade at lower multiples, even if the company is doing great. Second, your mortgage rates stay elevated. They're anchored to that 10-year Treasury yield, so if global demand for Treasuries drops, mortgage rates don't just magically float back down. Housing stays tight. Finally, corporate credit tightens. Credit is the lifeblood of business. When borrowing stays expensive, risk appetite tanks, deals dry up, and overall growth just grinds to a halt. You know, the narrative we're constantly sold is that one simple rate cut from the Fed just magically fixes everything, that liquidity is automatic, and someone, somewhere, will always just step up to buy our debt. But the tangible reality reshaping our markets right this second tells a very different story. Liquidity is the oxygen in the room. As this yen carry trade unwinds and the absolute cheapest source of money for the last 30 years dries up, I want to leave you with this final thought. What actually happens when the largest foreign buyer of our debt takes a step back? Who exactly is going to show up to take their place?